Tengo el gusto de presentarles a nuestro key speaker, el señor Bob Rinaldi. Bob es gerente de Amenbal & Halliday y presidente de Bob Rinaldi Advisor Services, empresa que presta sus servicios a empresas de leasing independientes, instituciones financieras, empresas manufactureras y a las entidades que están ingresando al mercado del financiamiento de equipos en Estados Unidos. Bob ha iniciado 2 compañías independientes de leasing en dicho mercado y las ha vendido exitosamente a 2 establecimientos bancarios. También se ha desempeñado como presidente y director de la Asociación de Leasing y Financiamiento de Equipos, ELFA, como miembro del Comité de Investigación de la Fundación de Leasing y Financiamiento de Equipos y en esta última entidad también como miembro del Comité de Desarrollo. Démosle un muy fuerte aplauso de bienvenida. Welcome, Bob.
Thank you. I'm learning. Well, thank you so much for having me. I am truly honored to be invited to come speak with you. And also thank you for honoring me and also Amenbal and Halliday for having us. I would certainly first off like to thank Alejandro and Felipe and your excellent team. Absolutely excellent team. You've got a great association working for you on your side. And I was so impressed today to see the Vice President know so much about your industry, as well as the Finance Minister. That doesn't happen in the United States. I mean, we work pretty hard at it, but even our senators don't know as much as your Vice President knows. So in a spirit of cooperation, would you mind leasing her to us for about a year? So I would also first like to start that I would like to apologize for my lack of Spanish. I'm working on it. I've spent the last 3 of the 4 weeks in Latin America. I've been in Mexico for the past 3 weeks. Just got married 3 weeks ago to my lovely wife, Emily. And she has been teaching me as well. She's been acting as my personal translator. And but I try to learn new words all the time, and you know, I've only been here a day, and I've learned a few new words. I'll try them out on you. Un otra cerveza Club Colombia, por favor. Aguardiente. And no más aguardiente. That was an experience. So without further ado, we'll talk a little bit about the industry in the United States and the trends in the United States. So we're going to talk about the United States, the big market overview from a very high level. And then we're going to break it down into some market sectors. And then we're going to talk about what I see as areas of growth in the United States. As you know, we are a very mature market. Roughly, the equipment leasing market in the United States, roughly $1 trillion. In terms of its impact to GDP, obviously something much greater than that, because that does not include the employees and the salaries and all that goes with it. And then we're going to talk about some future disruptors, and then Felipe and I are going to come up here and have a conversation and question and answer, if you will. So without further ado, what I'm showing you here is a chart that we pretty much live and die by at the association. And we have roughly 25 various types of leasing companies who make up what we call the MLFI survey. So every month we survey 25 companies, and those companies are very diversified. We have banks, we have captive leasing companies, we have small ticket leasing companies, we have all different types of industries. So it's meant to represent the industry barometer as a whole. And one of the things that we ask them is for what was their volume the prior month and the current month. So we're tracking the volume for those 25 companies, the leasing origination volume, every month. What you see in the blue bars is that volume. And so you can see that since the Great Recession of 2008, we've had a steady increase. So the black line is a trend line, and basically it looks like roughly 4% growth year over year. In the blue line The other thing we ask is delinquencies. How have your delinquencies changed from last month to this month? And we have tracked those for many years. And so you can see from the Great Recession to the trough somewhere in 2013, and then where we're at today. Now, you might look at that and say, well, it looks like delinquencies and charge-offs are in the red, by the way, which is complete defaults with recoveries on top of that, so the net charge-off is in red. You might look at that and say, well, things must be getting worse in the United States. If you just looked at this chart as it is, you would come to that conclusion. But if you looked out over the past 20 years, that number of sitting at 2% is still incredibly low. It's still an all-time low. So you could say that might be a little bit of a blip. You might say it would be a result of the change in the election with the new administration coming in, which was unpredicted. So the industry as a whole had to kind of figure out what to do about that and what did that mean to them. So you held off purchases and maybe held off payments, so the delinquencies might have ticked up. So a lot of things could go into that, and I guess all I'm cautioning is, and we caution the United States, I wouldn't read too much into that just yet. The latest tick up, we're seeing a lot of uncertainty. As you see the downturn in the first quarter of 2019 in volume, it could have been all the tariffs and all of the trade tensions with China and the United States. So a number of different things could go into that. I think the United States is starting to get used to all of this rhetoric back and forth as the new normal, and maybe we'll just kind of take it for granted and not worry too much more about it going forward. So the next chart is more macro economy, and if you will. This is the quarter-over-quarter percentage increase, or change, if you will, in real equipment, so real, after the adjustment for inflation, real equipment and software as a whole, and then some portion of that gets financed through our industry. So this is the big number. So this is presented by our economist. We have an economist through Keybridge Resource in the United States. So the ELFA has engaged an economist that we work with each and every month to help track these numbers and give us some information and insight. They're projecting and they're forecasting that there will be a downturn in the third quarter of 2019. A downturn, not a recession, just a slight downtick. So let's take a look at the various types of equipment. Obviously for us, the biggest one is transportation and IT. So IT and computer includes both software and computer equipment. So there's a lot of investment going on in the United States right now in cloud. So cloud computing, so many cloud computing centers are being added to, and so a lot more equipment. So we're seeing that, but I would say the largest increase though is on software. Transportation is a very big industry for us, but it's very broad. It's everything from rail cars, railroad, to tractor trailer, to any number of pieces of transportation equipment, including marine, barges, container ships, and aircraft as well. So these are our biggest sectors, and we're also showing you what parts of the country represent the greatest concentrations of our finance market. Any questions? So let's talk about where we're at with our various sectors. So in the United States, unlike Colombia, we have a lot of independent leasing companies. We certainly have banks, and we also have captive leasing companies, but we have a lot of independent leasing companies. These are independent leasing companies owned by entrepreneurs, not publicly held. As an example, I had a leasing company 20-some years ago that I then sold to a bank, so I was an independent. And in 2014, I purchased another small ticket leasing company and sold it in 2015 to a bank. So there's a lot of us out there who, after we get acquired by a bank, after several years, we may go out and start another one. So, but that's where a lot of the vibrancy is in the United States, is on the independent side. So one thing you'll see is the independents have grown way more than the banks and a lot larger than the captives. And if you take a look at the other way we look at our market, we look at ticket size being the cost per transaction. We have small ticket, which is anywhere from $25,000 US to $250,000 US is small ticket. $250,000 to $5 million is middle ticket, and $5 million and above is what we consider large ticket. And you can see that the small ticket has way outpaced any other sector. Now, I would tell you that the small ticket and the independents are very much related, because most of the independent leasing companies are doing small business leasing, and that also means small ticket. So those two things are very related. Because our independent is so vibrant, they are driving way more transactions than the banks are driving for small businesses. And that is just simply a matter of math. There's way more independent leasing companies who have many salespeople, so they're able to go out and touch many more small businesses and generate more transactions, and we have vibrant growth in that marketplace. So the other thing is the large ticket size has really been off for a long time. And I would tell you a lot of the reason for that has to do with regulation. And the banks not wanting to do very oversized transactions for one client. Also, many of those large ticket transactions tend to be very long-term, 10 years, sometimes 15 years for rail cars, corporate aircraft, commercial aircraft. And because of that, we use something called RAROC, if any of you have heard of that, risk-adjusted return on capital. And the longer the term, the more it affects the RAROC, which is how banks look at justifying, determining what their hurdle rate is on what transactions they will do and what transactions they won't. So the longer the term goes, the larger the impact negatively to RAROC, which then leads them not to do those transactions. So that's part of the reason that large ticket has been down. But there's a little bright spot in the horizon here, and hopefully somebody will remind me. I'll talk about that a little bit later. So with our economist also gives us a view on a quarterly basis of each equipment type. And each equipment type, and whether it's increasing, whether it's decreasing, looking forward 3 to 6 to 12 months out. So this is the forecast, the latest forecast we have right now. And basically what it would show you is that the areas that are the most strength right now is software. Trucks, which is trucking and tractor trailer, is good. Ships and boats are strong. Mining is still strong, but it may be peaking. And you can see in the far left-hand corner the areas that are just not doing as well from a standpoint of going forward, how we look at investing in different types of assets. So our banks and our equipment leasing companies look at this, and a lot of this is from experience, but they take this because the economist is looking at other things, what economic trends are going and what macroeconomic trends are happening to various sectors. Okay? Any questions? So recently, we had a credit and collections conference, and we have one every year. It's very heavily attended by credit managers across all of the types of companies, banks, captives, and independents. So the credit managers attend this conference, and roughly 300 to 400 will attend. And this one happened in June. And the significance of this is we use that that conference to survey those managers about what they're thinking and how they feel about certain sectors. So I pulled out a few slides of just some of the survey questions. So somebody was asking me yesterday at the board meeting here about regulatory, and is it getting worse? How strong is the regulatory environment? And this is the question basically that they asked the credit managers. If you take a look over the past 3 years, and they surveyed them every year in 2017, 2018, give us an effect of how much effect has regulation affected your business. Yellow, significant. orange, substantial, and red, a never-ending flood of demands. Never-ending flood of demands basically means that new requests from the regulators that they never requested before are now coming up, and the credit department has to stop what they're doing and go find that data and put it in a format, present it to the regulators, only for the regulators to say, I don't like that format. Can you give it to me another way? And they go back and they do that. So one thing to point is that the election of 2016, we had a new president, full year of 2017. People still didn't understand what was going to be asked of them and how the regulatory environment was going to change. You will see that in 2019, the reality sets in that this current administration was not going to press any harder on the regulatory side, on the finance side of the industry, okay? So how do they do that? They do that a number of ways. You couldn't change the laws that are on the books, but you could defund the organization so they have fewer people researching new things to ask the banks for. And that's probably what you see here. So the biggest significant takeaway I would give you on this slide is that things have tapered off in terms of further regulation on the financial industry in 2019. I don't know how to read the 2019, the significant side, the 49%. Certainly a tick up from the previous years, an increase, but I'm not really certain as to what would lead to that. I just think that I think the credit departments are getting more comfortable with what has been asked of them and what they're being asked to do, and that their systems are catching up and they're providing the data they're being asked for. And I think things have more or less normalized. So I wouldn't read too much more into that. But I thought this was an interesting take. I don't know what the regulatory environment here in Colombia is, whether it's increasing or decreasing, but this for us is a good news, is a good sign, in my opinion, going forward. So we also asked them, and we track predicted default rates in key industry equipment sectors. And this data is provided by PayNet. PayNet is our preeminent credit scoring company in the United States. And PayNet just got acquired a few months back by Experian. And so they have the largest data set about small business and small businesses and businesses in general in the United States. And so you can see that the actual default rates and what they're predicting based on their probability of default, which is what their scores predict, in these various sectors. So overall, it's 2.5%. Transportation is 4.2%. And I'm going to show you a slide here that kind of is really a little contradictory to this, but it is kind of interesting when you think about it. So the transportation sector obviously is the highest here, but it's also one of our largest sectors. So not sure how to read into that one, but this is what they're projecting going forward. Still, these numbers, while it looks like it's going up from 2018 to 2019 and 2020, is still, as I mentioned earlier, not that significant when you look at a bigger picture over a horizon of 10 or 15 years, 20 years. So going back to the credit manager survey, a question was asked of the credit managers: what industries are you interested in increasing your exposure to or decreasing your exposure to? Now, again, keep in mind, as I said, this is the credit managers were asked this question, not the regulators. The credit managers, the ones that say yes or no on a decision of doing equipment leases. And so you see that the vast majority agree that construction is where they want to increase their exposure. That would tell me that the credit managers are bullish on the economic environment in the United States, right? Because there's building houses, building buildings, building apartment complexes, building office buildings. So they're very confident about that particular sector. Manufacturing is up, surprising. This is machine tools, very large pieces of equipment, a lifespan of 20 years. okay? And that's up significantly. I think the takeaway, obviously, is the concern is on mining, the concern is on energy, but you can see that the credit managers are evenly torn on energy, with half wanting to increase and half wanting to decrease their exposure. Same for, the interesting thing is transportation. 17% don't want to go that way, want to reduce their exposure, but 34% want to increase. As I mentioned in that slide previously, if the transportation sector looks like it's going to tick up from 2018 from 3% predicted default rate to 4.2, that's the prediction, but the credit managers want to increase their exposure to transportation. That's something to kind of consider and think, what is causing that? Well, basically, they're still bullish. So you've got a quantitative analytical research company who's predicting that the probability of default is going up in that sector, going out in the years, but the credit managers who are actually seeing the financial statements for these particular assets and the companies who are buying them, okay, they see something different. Yeah. Question? Somebody bring him a mic. And then somebody translate.
Tengo una pregunta y es sobre la probabilidad de default en la diapositiva anterior, el slide anterior. La mayor probabilidad de default la tiene el sector de transporte. Me gustaría saber si tienen algunas variables identificadas de por qué es el mayor sector con esa probabilidad.
Okay. So the reason for transportation is that over the past 12 to 18 months, we have seen a number of defaults of small transportation companies. The reason for that has been the price range, or what's the right word I'm looking for, Carl? The price per load. In other words, the prices that the small trucking companies are being paid for each load has gone down significantly. So the large trucking companies have been able to weather that, but the small trucking companies have not been able to weather that. So there has been a number of not only delinquencies, but there has also been actual defaults of small trucking companies in the United States. I believe that's part of it. I don't know what else it could be, but I think that's the large, and we're seeing a lot of articles about that being written in the United States, so we're seeing more activity on that side. I'm guessing that's part of it, because the moment they start seeing delinquency today, in that projection, since this is all quantitative and forecasting out into the out years, the delinquency today, they're forecasting some percentage of that defaults in the future year. So it's an analytical equation, it's part of the algorithm. Does that answer the question? Okay. So, where were we? Okay. Are there any other questions before we? Okay. So, factors impacting pricing pressures. So this was asked of the credit managers again. What is causing the greatest amount of pricing pressure, and what are the top 5 reasons for that? So the financial institutions are being asked to take a higher residual value in order to drive the monthly payment down, to be more competitive. It's one reason. But I honestly think that, as you can see for yourself, the biggest reason is increased competition. And that competition is coming from the banks, between bank to bank, and between independents. One thing I didn't mention before, but our independent leasing companies are financed, majority of them are financed by the leasing departments of the banks. So while they are different sectors, one is still very dependent upon the other, and the banks are highly dependent upon the independents for production of origination volume. And so as you can see, the volume considerations as well. So if you are projecting, as your bank operation is projecting a 4% growth, you need to find some way to increase your volume 4%. How do you do that? You can get more competitive on rate. You could increase your residual values, therefore driving the rate down. So those are some of the most interesting ones that we see at the current moment. And this shows year over year, by the way. So it's, and long and short of it, things haven't really changed on any one of these sectors. None of them have changed greatly, except in 2019 with the increased cost of funds. The Federal Reserve in the United States in 2018, 2019 started increasing interest rates. And if you heard, as of yesterday, the Federal Reserve decided to decrease rates by 1/4 point. So a sharp reversal. So I venture to bet that when asked the same question next year, that the increased cost of funds section will probably go back down. So let's talk about the market sectors and what each market sector is facing. So the bank equipment finance companies have great headwinds, and the great headwinds are a number of things, not just the regulatory stuff that they're faced with, but they're faced with Basel III compliance, and they're faced with something called CECL, another compliance measure, which I don't think you face here. CECL is the abbreviation, but bottom line is it's a change in how you take provisions for losses. When you write a transaction today, they want you to project what your loss is going to be and take it today. And that gets very difficult if you're doing equipment leases and taking residual values, because it also affects the residual value equation. Basel III takes into account risk assets, and residuals are considered risk assets. So these are creating headwinds in the terms of the RAROC analysis of the types of transactions that banks can do. So there's great headwinds there. But on the bright spot, we're seeing a lot of very small banks. And in the United States, we have roughly, I want to say 6,000 small banks. Names you've never heard of, but all across the country. And some are very small, and some are medium-sized, but they're located all across the country. And so the small banks are starting to get into the equipment leasing and finance industry. So we're seeing roughly 10 to 15 banks, new banks a year coming into the business. So from the banking sector, that's a positive thing. On the captive side, the same item is both a positive and a negative, and it's equipment as a service. You have another term for that, Felipe. What do you all call that? Where you just equipment and you just pay the monthly payment and you don't buy or lease it. It's like software as a service. So where customers just want the use of the equipment for whatever period of time they want to use it, and then give it back when they're done, but including services. It's kind of like a rent, but it's like the Airbnb, the Uberization is coming to the captives, and only the captives can solve this need. The banks can't solve the need because you can't write a contract with an undefined term, right? It's not possible to do that if the term is uncertain, and you can't put in services and provide the services. So the captives are doing that. So the captives are struggling with that. So it's both an opportunity and it's a problem because it changes their revenue recognition system on the portion of business that they write under this new structure. But large companies are asking for this type of structure, and it tends to be localized in IT and software. It tends to be localized in material handling, forklifts, and the like. So those are two main sectors that we see that, but there's a lot of pressure on the captives for that. The independent and middle market, I combine those because in the United States, the ELFA has an independent middle market business sector. Well, not every independent does middle market, which is middle ticket transactions, $250 to $5 million per transaction. But most of the independents do small ticket, but I'll keep those together. And we are still facing spread compressions because many of the small banks that are getting into the leasing industry, they are buying small leasing companies, and they're getting into the small ticket leasing business as well. And because of their lower cost of funds, they are lowering the rate, and you have compression spreads. We are seeing, as I mentioned before, I'll talk about it briefly, we're seeing maybe a little bit of bright spot on the large ticket. So these are the transactions 5 million and above. So in the 5 million and above sectors, I said banks have stayed away from it, but we've had a couple new entrants over the past year, one specifically, who took the idea of securitizations. Do you all know what asset-backed securitizations are? Anybody not know what that is? It's where you pool up a bunch of transactions and you put them in a pool and you sell them to investors. That typically works when the assets are all homogeneous. Homogeneous meaning they're all roughly the same kind, the same size of transaction, and they're geographically dispersed across the United States, and they're dispersed across industry sectors as well. But in a large ticket sector, if you had a 200 million US dollar securitization and one transaction was $50 million for one piece of equipment, and another transaction was $10 million, so you only had maybe 15 transactions in the securitization, you would never think that that would work. Well, we've come up with a hybrid securitization, and it has gained a lot of popularity by one particular company, and now it's gained a Moody's rating of AA, so very well credit rated, and it keeps being upgraded. And because of that, the banks and the insurance companies are then buying pieces of that securitization. So they are not buying that lease, but they're buying a piece of a securitization that has a AA rating from a credit perspective. So now the banks are able to get back in to the large ticket business, but through a securitization. So that is a bright spot that we're seeing. It remains to be seen how that is, but we shall see. So the small ticket vendor programs, that and small ticket and vendor programs is really where the action's at in the United States. That's seriously where the action's at. Because again, the securitization marketplace has really come into being and really supporting doing a lot of these transactions, and therefore a lot of the companies that are out there doing the transactions are hiring more sales reps, and they're doing even more transactions for small business. So the winner in the whole equation is the small business, are getting capital for equipment investment. Other areas that the small ticket, as I mentioned before, the small bank entries are buying the small ticket leasing companies, and we're also seeing great strides in artificial intelligence and in credit scoring. And we're seeing a lot of automation, thanks to great companies like Alpha and Odessa and Tamarack. They're really pushing the envelope with technology, and especially electronic contracts. We're using, I would say, probably 60%, if not more, of all small ticket transactions for small businesses are done electronically. The customer never gets a piece of paper. It's all through the internet. And the credit scoring is allowing the small ticket leasing companies to get approvals within less than 4 hours, and usually less than 30 minutes. So DLL, you've heard of DLL. DLL probably approves transactions now in small ticket 20 seconds. So within 20 seconds from the application coming in, it gets approved, if it is approved, and then within a minute later, the contracts are electronically sent to the customer to be executed. So there's a lot going on in that area. So I talked about the areas of growth for the United States now, and that is small business. How are we on time, by the way? We good? So small business is the biggest area of growth in the United States. Let me tell you why. In the United States, we have roughly 30 million small businesses. And those small businesses generate over 50% of the GDP of the United States. So here's some, next two slides are from the Small Business Administration from the US government. Now, their definition of a small business, I think, is a big fee. It's 500 employees and under. And 99.9% of all businesses in the United States are small business. But my guess is over 80% of all of those are less than 20 employees. So I think this 500 number needs to be changed because it's not representative of what's real out there on the street. Again, 80% of those small businesses are less than 20 employees. And net new jobs in the United States, 66% of all net new jobs come from small businesses. And that makes sense if you think about it, because the large corporations are using technology and becoming more efficient, needing fewer people. And if they're manufacturing, they're using more efficient equipment with robotics, and fewer people are needed. So the small business sector is probably one of our largest, is our largest generator of activity and the vibrancy of our economy. And right now, the longest recovery we've had in the United States in history, roughly 10 years now, without a recession. That's kind of unheard of. And I personally think it's because the small business sector really insulates the economies from great swings because it's so diverse. And oh, by the way, the small businesses are way more adaptable to change. So the next slide, and here's an interesting thing, that 80% of all these new businesses show no employees other than the owner. And you think, well, that makes no sense. Well, it kind of does, because they outsource everything. They hire contractors as opposed to hire employees. So if their business grows, they bring more contractors. If the business shrinks, they let the contractors go. But they don't have employees. So it's truly, the Uberization is still really kind of picking up steam in the United States. So the far right side talks about new business startups. So on average, we average, let's say this data goes back to 2015, but 414 new businesses starting up each year, and roughly 396,000 closures each year. That's being reported to the federal government. So as long as that startup number is higher than the closures, we're in pretty good shape. We also do track who owns these companies: minority, non-minority, African American, Asian, veteran, women-owned. And you can see the women-owned businesses at 9.9% of the total, male-owned 9.9 million, and males 14.8 million. So the equality is starting to catch up. So the areas of growth: small business nominal GDP. So this data is from 2014, and at that time the GDP was $17 trillion roughly, between 15 and 17. So you can see that the small business sector represents close to 50% of the GDP of the United States. And in the gray bars is when we had recessions, by the way. And this talks about the large business share and a small business share of the U.S. economy. Again, going back to 2014. It's just another piece of information. And this was done by an independent research study done by Catherine Kobe Economic Consulting Services in Washington, D.C. So again, more support. Well, you know, why do I dwell on this so much about small business? Because the small businesses are undercapitalized and always have been undercapitalized. But because of technology and credit scoring, and in some cases artificial intelligence, we're able to reach out to many more small businesses and solve their capital needs. So in our industry, in equipment leasing industry, we have done that through technology with electronic contracts. So keep in mind, if you're going to do a $20,000 transaction, US dollar transaction, you have the same costs that you do if you did a $200,000 contract. So you've got to get the expense ratio down on the small contracts, and you've got to the friction in those transactions to make them profitable. And that's what's being done. When it becomes more profitable, more leasing companies get into the business, hire more people, and actually go out and meet more small businesses and meet more small business needs. On top of that, the fintech industry has come in as well. While we provide financing for asset-based transactions, equipment, the fintech industry has come in and providing financing for intangibles, working capital, additional cash flow needs, additional inventory needs. Somebody wants to build an extension to their warehouse, okay? How would they do that? Equipment leasing company cannot do that. A bank is not going to do that. Fintechs do, because they can predict and project the loss ratios. So it's not so much about small business. You can take a risky sector of the small business industry, and even if you have a 7 or an 8% default rate projection, which is very high, you can still, if you can price for it and you can accurately predict it, you can lend to that business. Now, that does mean the rate's going to be higher for that business, but if they can't get any capital any other way, you're providing valuable capital. So the fintech industry has really played a major role in providing that. And the more that happens, the more we will find vibrancy in the U.S. economy. And frankly, I think in any economy, the more vibrant their small businesses, the more vibrant their economy will be overall. And if you think about it, the income inequality equation will get solved in that manner. The more companies that are out there, small businesses that are out there employing more people. So now let's go to what also is helping the small business transactions. So the securitization market, this is taking a look at 2018 and 2019 asset-backed securities in the United States, and I have outlined for you just the equipment portion. So that is roughly, if I can read that closely, $8.2 billion worth of equipment transactions, or 8,000. What does that say? Yeah, 8.2 and 9.4 in 2019 is projected through June of 2019. So year to date versus year to date, 2019 is up. That is really significant because many smaller leasing companies are going to the securitization marketplace. And by the way, the banks are helping them. So let's talk about why they want to do that. This is the cost of funds. Now consider this, that on the left-hand side, on the y-axis, is the spread, basis point spread, over the like term U.S. swap rate. Okay? And these are the various quality of it. So you will see A and AAA up here. And if you take a look where we're at today, because since the 2010, the investor community has gotten very comfortable with buying strips of equipment asset-backed securities. And so the cost of funds sits at roughly, if you take a look at the top line, the green line, which is 3-year, which would be your typical small ticket transaction, a 3-year transaction, single A rated, sits at 60 basis points over swaps. That's pretty much close to bank cost of funds to the particular departments. That's not what the bank's true cost of funds is with deposits and things like that. But that's a very low cost of funds. And it gets very profitable now for an independent leasing company to utilize this this marketplace of securitizations. So by now increasing their technology improvement, increasing their efficiency, reducing their cost of funds, it becomes much more profitable to do small business transactions. even in a $20,000 range or $10,000 range. So that's what's leading to the vibrancy. It's all feeding upon itself. So that's where I see the excitement in the United States market. Don't know whether that's a takeaway here, but it certainly has helped us, and I certainly believe that it's helped the U.S. economy keep expanding over these past 10 years, longer than anybody ever predicted it should. Any questions at this point? Okay. So, kind of toward the end here of the presentation, what are the potential disruptors for our industry? Well, your finance minister talked about blockchain, and blockchain seriously is a potential disruptor. Well, how could that be a disruptor in what way? I'll give you an example. So I was sitting on the board not long ago of a fintech company, called Fintrux, F-I-N-T-R-U-X, you can look it up. They're out of Singapore, and they started up a business-to-business, peer-to-peer lending, commercial lending business platform, all powered by the blockchain, organically written on the blockchain, okay, and they've launched it in Singapore last month. So you are seeing now that anybody can be a lender to a business that needs capital, and you don't need the technology. You don't need an accounting system because the blockchain provides an immutable ledger of the entire transaction in perpetuity, forever. It's immutable. It's there. It won't be changed. And it can only be changed, the transaction can be changed, when those two individuals whose access is highly encrypted and highly identifiable agree to change that contract. And blockchain, using smart contracts, basically weaponizes a software into operational capability. A certain action happens, the blockchain kicks off an activity, as opposed to somebody having to pick up the phone. So it holds a lot of opportunity. It's still very early in its stage. More investment is being made and needs to be made in the infrastructure for blockchain because it's still not very efficient right now. But I was one not believing too much in it about 3 years ago, but I am certainly convinced that it can change things. And artificial intelligence already has changed a lot in our industry, and it's going to change a whole lot more. And fintechs are leading the way. The equipment as a service is a potential disruptor. As you know, look around the room, many of you are a lot younger than the folks in our industry. But my children, you know, I've got 4 kids, the oldest is 30 and 28, and they live by Uber, they live by Airbnb, Amazon. They're used to getting what they want, when they want it, only for as long as they want it. And they are getting to become the age that they are becoming managers, and they're becoming decision makers. Do you think that maybe that mentality will change? How will they make a decision for their company who needs a piece of equipment or an asset? Do you think it might change? Do you think they might push the envelope? I think so. So I think that's where we're going to see a lot of things change in that sector. So it's best to be prepared, keep your eyes open, read a lot of articles. How many of you ever heard of a website called Medium, M-E-D-I-U-M? Medium is a news outlet that anybody can publish news, but it's highly concentrated on technology. So technology articles coming out every day, very highly concentrated on blockchain. So I would tell you, at least subscribe to it. It's electronic, doesn't cost you anything, and if you're so compelled, you can write an article. And oh, by the way, you can rebut an article online. And it's very interesting stuff just to stay appraised of what's going on and how might that affect you or affect your business. The good news is I think this is the most exciting time in the world to be in this business. I'm excited to be in this business. I feel like I'm just getting started again, even though I'm just turned 60 years old. So anyway, so that concludes the presentation, formal part of the presentation. Felipe, you wanted to come up and, or do you want to, how do you want to do this?